Chapter 15, Financial Statement Analysis. The analysis of increases and decreases in the amount and percentage of comparative financial statement items is called horizontal analysis. Each item on the most recent statement is compared with the same item on one or more earlier statements in terms of the amount of increases or decreases and the percent of increase or decrease. When comparing statements, the earlier statement is normally used as the base year for computing increases and decreases. The percentage analysis of the relationship of each component in a financial statement to a total within the statement is called vertical analysis. In a vertical analysis of the balance sheet, the percentages are computed as follows. Each asset item is stated as a percent of the total assets, and each liability and stockholders' equity item is stated as a percent of the total liabilities and stockholders' equity. In a vertical analysis of the income statement, each item is stated as a percent of sales. In a common size statement, all items are expressed as percentages with no dollar amounts shown. Common size statements are useful for comparing one company with another or comparing a company with industry averages. All users of financial statements are interested in the ability of a company to do the following. How they maintain their liquidity and solvency, and how they earn income, which is also called profitability. The ability of a company to convert assets into cash is called liquidity, and while the ability of a company to pay its debts is called solvency, liquidity, solvency, and profitability are all interrelated. Liquidity and solvency are normally assessed using current position analysis, accounts receivable analysis, and inventory analysis. The ratio of fixed assets to long-term liabilities, the ratio of liabilities to stockholders' equity, and the number of times interest charges are earned. When looking at the current position analysis, you have working capital, current ratio, and quick ratio. When looking at accounts receivable analysis, we use accounts receivable turnover, or the number of days sales in receivables. With inventory analysis, we use the inventory turnover, or number of days sales in inventory. A company's ability to pay its current liabilities is called current position analysis, and the current position analysis is a solvency measure of special interest to short-term creditors and includes the computation and analysis of working capital, current ratio, and quick ratio. Common profitability analyses include the following. So common profitability analyses, we look at the ratio of sales to assets, the rate earned on total assets, the rate earned on stockholders' equity, the rate earned on common stockholders' equity, our earnings per share on common stock, price earnings ratio, dividends per share, dividend yield. It's a lot.
That's what that's all the names for the stockholders' equity, right? All the things that can be called.
So these are the different, so these are all formulas. So the common profitability, this is the way that we analyze it. I analyze our profitability. And so when analyzing our profitability, we could use any one of these, or we could use more than one of these. We could use all of these. But it's just different ways that we can do a computation to analyze our profitability. And here's all of our formulas. So, summary of analytical measures. This is slide 9, telling us these are our liquidity and solvency measurements. All of these. And then the way that we compute those and what they're used for. So in this first one, working capital. To compute working capital, we're going to take current assets minus current liabilities. That gives us our working capital. And this ratio, or this calculation, is used to indicate the ability to meet current maturing obligations. It measures our solvency. Notice this right here is saying that both of these do the same thing right here. So it's saying working capital, and also your current ratio can be used as well. So when you look at your current ratio is your current assets divided by your current liabilities. That's how you compute it. And your current ratio is used to indicate the ability to meet currently maturing obligations. It measures solvency. So that's how you read through this. We also have the quick ratio. Quick ratio is quick assets divided by current liabilities, and that's used to indicate instant debt paying ability. It measures your solvency. Our assets turnover, or I'm sorry, our accounts receivable turnover is sales divided by average accounts receivable, and the accounts receivable turnover is used to assess the efficiency in collecting receivables, and in the management of credit, it measures our liquidity. Number of days sales in receivables. To calculate that, you would take average accounts receivable divided by average daily sales, and that is, again, it's a liquidity. Your inventory turnover is calculated by taking your cost of goods sold divided by average inventory. It is to assess the efficiency in the management of inventory, measures liquidity. Number of days sales in inventory. You take your average inventory divided by the average daily cost of goods sold, and the number of days sales in inventory is used to assess the efficiency in management inventory and measures liquidity. Ratio of fixed assets to long-term liabilities is your fixed assets net divided by your long-term liabilities. This is used to indicate the margin of safety to long-term creditors. It measures your solvency. Ratio of liabilities to stockholders' equity is total liabilities divided by stockholders' equity, and it is a solvency, and it's used to indicate the margin of safety to creditors. Number of times interest changes are earned. You take your income before income tax plus your interest expense, divide that by your interest expense, and this is used to assess the risk of debt holders in terms of number of times interest earned, and it measures solvency. And then number of times preferred dividends are earned is your net income divided by your preferred dividends, and that's used to assess the risk to preferred stockholders in terms of the number of times preferred dividends were earned, and it measures your solvency. That's a lot of formulas. So this is slide 9. If you need to go back and take a look at that, or print it out or something like that. Yeah.
It's a lot.
There's a lot there. Some of these we've seen in previous chapters, so you may already know those. like current ratio, quick ratio, those are kind of frequently used, but some of these other ones you might want to refer back to slide 9. And it continues to slide 10. So ratio of sales to assets is your sales divided by average total sales, excluding your long-term investments. The rate earned on total assets is net income plus interest expense divided by average total assets. I'm going to let you guys read through these, but definitely do, because you will see these again. You're going to need these to do some of your homework problems. So slides 9 and 10. Corporate annual reports, in addition to the financial statements and the accompanying notes, corporate annual reports normally include management discussion and analysis, also known as MD&A, the report on internal control, and the report on fairness of the financial statements. Management's discussion and analysis, MD&A, is required in annual reports filed with the Securities and Exchange Commission, the SEC. It includes management's analysis of current operations and its plans for the future. Typical items included in the MD&A are management's analysis and explanations of any significant changes between the current and prior year's financial statements. Important accounting principles or policies that could affect interpretation of the financial statements, including the effect of changes in accounting principles or the adoption of new accounting principles. Management's assessment of the company's liquidity and the availability of capital to the company. The significant risk exposures that might affect the company. And any off-balance sheet arrangements, such as leases that are not included directly in the financial statements. The Sarbanes-Oxley Act of 2002, SOX, requires a report by management. This report states management's responsibility for establishing and maintaining internal control. In addition, management's assessment of the effectiveness of internal controls over financial reporting is included in the report. Sarbanes-Oxley also requires a public accounting firm to verify management's conclusions on internal control. Thus, 2 reports on internal control, one by management and one by a public accounting firm, are included in the annual report. All publicly held corporations are required to have an independent audit or examination of their financial statements. A certified public accounting firm or a CPA firm that conducts the audit renders an opinion called the Report of Independent Registered Public Accounting Firm, and the opinion is on the fairness of the financial statements. Generally accepted accounting principles require that unusual items must be reported separately on the income statement. And this is because such items do not occur frequently, so they're typically unrelated to current operations. So something that, it could be a plant was destroyed due to a hurricane or something happened hardly ever. Just something that's unusual that doesn't happen very often. Unusual items on the income statement are classified as affecting the current period income statement or affecting a prior period income statement. Current period would be the period that we're in. So if we're looking at month to month, we're currently in February, so this is our current period. January would have been our prior period. A company may discontinue a component of its operations by selling or abandoning the component's operations if the discontinued component is the result of a strategic shift and has a major effect on the entity's operations and financial results, Any gain or loss on discontinued operations is reported on the income statement as a gain or loss from discontinued operations. A note to the financial statements should describe the operations sold, including the date the operations were discontinued and details about the assets, liabilities, income, and expenses of the discontinued component. Extraordinary items. An extraordinary item is defined as an event or transaction which both happened in an unusual nature, it's an infrequent occurrence, and any gain or loss from an extraordinary item is reported on the income statement as gain or loss from extraordinary item. Earnings per share should be prepared separately in the notes to the financial statements for discontinued and extraordinary items because they're both they're not common. An unusual item may occur that affects a prior period's income statement. Two of those items are as follows. You could have errors in applying your GAAP principles, generally accepted accounting principles. You could also have changes from one principle to another. So maybe there were some GAAP changes and you need to note those. And practice questions. So which of the following is the most useful in analyzing companies of different sizes? We're analyzing companies that are different sizes. We've got a small business and a big corporation, but they're in the same market. So a comparative statement would
Common-sized
be a
financial statement.
Yep, a common-sized financial statement. That's where we're bringing the financial statements in on common size, basically. So a common-sized financial statement makes analyzing two companies that are different sizes easier. Which of the following measures a company's ability to pay its current liabilities?
Yep.
I was like, we've said this a bunch. Y'all better get this. Good job. Current ratio, that's correct. The relationship of 325,000 to 125,000 expressed as a ratio.
$2.26.
325 divided by 125 gives you 2.6. Yep.